Improving Alpha, Innovation in Investing, ESG, and Technology with Michael Oliver Weinberg is being sponsored by Alternatives Watch and powered by Vidrio Financial. For a 360-degree view of investor mandate activity across alternative investments, turn to Alternatives Watch. Vidrio Financial is the first technology-enabled service for allocators looking to harness investment complexity and make better allocation decisions. Learn more at vidrio.com. That is VIDRIO.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Scott Pittman, Chief Investment Officer of the Mount Sinai Medical Center, will join us. So listeners have a high-level sense of our roadmap for today. We will start with some background, then discuss investing, ESG, and technology. Investors and business leaders should be able to extract a great deal of value from Scott's insight. I can attest to that, as Scott recently was kind enough to speak at our class at Columbia Business School, and that was great. On that note, welcome, Scott.
Thanks, Michael. Good to connect, and appreciate you having me join.
Great. Let's start briefly with your career, how it evolved to where you are today, and perhaps you could touch on where you are today and what you're doing there briefly.
Sure. I guess the high level, very quick summary is I certainly do love and have a passion for investing and also for science. So Mount Sinai has been a great combination of the two. I guess the details and how I got to where I am today, really go back to early years where I did love both business and science. And so I was pre-med business. In my undergrad, I actually went ahead and got my EMT certifications and spent at least my junior and senior years, several of my weekends on ambulances, trying to get a feel for a little bit more of the hands-on what the healthcare, might feel and look like from that end. I did love the business side though, and actually had some mentors on the healthcare end. And, long story short, I ended up on the business side of healthcare and spent about 5 years. And found myself, frankly, looking for something a little bit different. And so I had gone back to my MBA, which is not uncommon, obviously, for more some transition aspects. And as I did that, and I spent more time in some of the research and the finance and investment classes, I realized that was really a direction that I had a passion for and wanted to pursue, which kind of led to the next stage, which was kind of the chairs for the economics and finance department asked if I'd be interested in helping with some research and staying on to teach full-time. So that led me into teaching corporate finance and some sections of micro and macroeconomics, which I did for 2 years at Baylor. And around the time that I was actually looking to move from teaching and actually potentially go and join a hedge fund, it was serendipitous because Baylor had just brought their assets back in-house, and Jonathan Hook had joined as the CIO to manage that investment office. And John and I were talking, and he was looking to build out the office and the portfolio, and it was just a fantastic time. And so I decided to go down that path, and very thankful for it, and obviously very thankful to John and kind of that first initial step into an endowment role. And John and I worked alongside in building out Baylor's endowment office and bringing in additional staff and taking the assets and getting those invested. And ultimately that led to me moving to Mount Sinai right at the end of 2008, which certainly 2008 was an interesting time period for financial markets. But it just coincided with Mount Sinai looking to bring in a CIO and build out their investment office. And so that opportunity presented itself. And so I've been here now, not quite 15 years, but coming up on 15 years at the end of this year. So it's been a wonderful fast experience, and thankful to be working in a healthcare environment that kind of brings back that love of science with investing.
Yeah, and it's obviously a great institution that you're with. That said, maybe you could share a little bit about the endowment, targets, assets under management, who you're investing on behalf, though I have a sense of that.
Absolutely, and it's an excellent question because I think individuals understand what a foundation looks like and does, and what a university endowment looks like, and how they're structured. family offices, pensions. But hospital systems are this complex, system that does have a little bit of everything. And some healthcare systems may have one or two. Healthcare system like Mount Sinai has a little bit, honestly, of kind of all the little areas, and I'll highlight those. But going back to when I joined and building out the investment office, the focal point in the initial hiring to build out that office was to manage the long-term pool or endowment. And those words really are interchangeable. A little bit of a difference in what the long-term pool versus endowment for a university might be like. We have more unrestricted capital as part of our endowment as opposed to a university endowment, although university endowments do have unrestricted capital. We just have more of that. But we do have restricted endowed funds. We have medical students that, just like university has students, we have department chairs of various areas like cardiology, where endowed funds help support those chairs. And just like a university has their endowment support operations, our endowment helps us support operations for Mount Sinai. We have a spending rate placed against our endowment in the same way, where the complexity of healthcare really starts to expand over the years as the investment office has supported the investment and outcomes for the endowment and its long-term pool. There have been other areas that we help manage or advise on, and kind of those roles of advisement have been, sometimes more or less in terms of our touch points. And so, you have a short-term capital that technically is operating funds, but isn't necessarily to be used in the immediate term. And so our office helps support some of those operating funds. They're mostly, from a retirement standpoint, are DC assets, but we help in the advisement of the DC plan. There are some DB assets, as there have been some mergers and acquisitions over time. We help kind of support, again, there as a sounding board to the DB assets. And then there are insurance, both health insurance and reinsurance for the medical malpractice, where there are equity ties to various entities. And I sit as the investment committee chair for those entities to help in the overseeing of the assets and, again, supporting outcomes. And then a lot of healthcare entities have some form of strategic balance sheet investments that may take place. For medical centers that have a school, there's probably more of that from the innovation side and the commercialization and the licensing that can take place. But even for healthcare systems that don't have a medical school, there may be strategic alignment or strategic benefits that come about that drive more of the balance sheet investments. And so I support a committee within Mount Sinai comprised of other individuals, but that committee also does get involved in some of the organization's balance sheet strategic investments and ultimate monetization. So a lot of areas within healthcare. While the investment office has a prime objective, we do help support a lot of other of these pools that certainly are still very important for various reasons.
Wow. Yeah, it's quite broad and complex, but super interesting. And let's get to the crux of this episode. I've probably waited too long to get us here. And let's talk about innovation, and that's what this podcast really tries to get at. How are you innovating to improve alpha for starters, an investment perspective?
Sure. Yes, it's an excellent question, and certainly an area to focus in. I like to say for Mount Sinai, one of the areas that we've been able to do this and to get to the heart of it and then to provide a little context around it is we've tried to lean into our best ideas. Our best ideas might be specific investment opportunities. Those best ideas might be longer term themes. But to lean in ultimately means to build greater conviction and greater concentration into those opportunities. So I think one of the ways that we've tried to, and at least have successfully thus far, been able to achieve good outcomes has been by, having concentration and conviction in our best ideas. If you kind of step out and look a little bit more broadly at that, really investors have a few levers they can use to drive returns. Certainly controlling risk is a equal and important conversation, but in driving the returns and hopefully driving value add in the sense of innovating alpha, I mean, you can certainly use directional risk taking, and whether you want to use the term beta or not, certainly kind of aligns with that. But that directional risk taking can be through public markets, it can be through private markets, it can be through non-equity markets and credit. But ultimately, you are using research and you're using fundamental analysis or quantitative analysis to drive a certain measure of risk taking that's more of a beta orientational directional risk. Leverage is another one. Certainly another lever that gets used. Relative value, gross exposure, long short, real estate using debt. Certainly private equity strategies, not all, some are, have and will use debt to help drive returns. And so I think that when you look at institutional investors, the areas of directional risk taking and the use of leverage have been fairly well accounted for and are still important to use. I'm not saying, investors shouldn't be taking beta and investors shouldn't, at the right points in time, can't use leverage effectively. But those are areas that are pretty well understood and pretty well utilized. I think the area that's less utilized, and doesn't mean it's appropriate in every case, but is this area of concentration of best ideas where you can be diversified, but you don't necessarily have to be in everything. In certain markets or certain strategies, there may be reason to have greater concentration in those markets or those strategies. And it may mean that public markets make sense in some markets and private markets make sense in other markets. But understanding how you want to really drive your implementation and concentrating that implementation while still maintaining appropriate diversification. Because the real takeaway, I think, in all this is most portfolios have so many underlying positions that when you look at the portfolio level, you're really recreating, betas and, market-like exposures. And for most part, active managers are being used and you're paying fees for the active management. And so you're not getting that benefit at the portfolio level by having so many positions that get accumulated within the portfolio.
Plus, if you're paying managers, obviously you have the added burden of bearing the netting risk, right?
Yeah, absolutely. And so we've, if you take it to one extreme, I don't think an institutional investor would have all of their assets in a single manager and single strategy. That would be seen as not being prudent and wouldn't necessarily be, I think, a fiduciary responsibility. But on the other side, if you look at industry data, it points to endowments and foundations having, on average, about 100 to 110 manager relationships. And that range is around 40 to 200. And, those managers themselves are reasonably diversified. Some are very diversified. And so if you look at a typical portfolio with 100 manager relationships, and you look at those managers and their underlying positions, and you roll that up to a portfolio level, that's a lot of market exposure with active fees. And so we've just tried to pull back on that to say, yes, diversification is a key principle investing. You definitely want to be diversified, but at the same token, we, even going back to academics, know that with 20 stocks, and it has to be the right 20 stocks, but you can diversify, the S&P 500 through 20 stocks. And so you don't get a lot of additional benefit, and you don't get the benefit potentially of your active tracking error by then putting in too many and layering in other positions. So we just try to balance between these measures of diversification and still maintaining conviction.
Yeah, well, I think you've hit on a really good point, because I do think, having been an allocator for the past 20 years and knowing so many like yourself, I think that over diversification is definitely not is definitely suboptimal. And to your point, if you have 200 managers and you have each manager has 50 to 100 positions, or again, depends on the strategy and the fund and et cetera. But that ends up there are probably massive diminishing returns, the netting risk, and then to your point, the dilution of any alpha that they or you may be adding through the allocation process. But taking that very high level conceptual framework that you apply to a more practical level, are you comfortable? Could you maybe share? It doesn't have to be managers per se or investment in specific investments, but like where you're leaning into, as you alluded to, or trying to add alpha, or where you see directional opportunities?
Sure, and I'll give some examples. And then as you were talking too, I was reminded of something that really is less portfolio investment related in terms of improving alpha. And I think points more to aspects of governance and team culture that support, I think, the process of driving alpha. And I'll come back to that in a second. I just mentioned that now because I don't want to forget myself. But in terms of
Sure.
getting to historical examples in our portfolio and even current examples, a really quick and easy historical example is coming out of the financial crisis. And I kind of mentioned I got here at the end of 2008. Looking back, we could have all just invested in risk and got home. But at that point in time, there still was a lot more uncertainty. And credit in particular was offering highly attractive returns. And while you didn't necessarily know where equities might go in the recovery and certainly the financial system in itself, there's a little bit more in terms of capital preservation within the credit strategies. So we did lean in and built out a fairly sizable position within credit. And as we did that, we got to understand the structured credit space even more so. And so as we leaned into credit, we leaned into structured credit. And as we built exposure into structured credit, we got to better understand TRUP CDOs and found the TRUP CDO space itself to be really well diversified and to be misunderstood, and found that this group of securities was quite attractive. And so we concentrated within TRUP CDOs within a concentration to structured credit within an expanded allocation to credit. So that being kind of one example of kind of working into then at that point in time a dislocation. There have been times in the past where we're not doing anything today around music royalties, but back in 2014, 2015, and 2016, we did find the space to be really attractive from a valuation standpoint and return, and didn't find it to be very institutionalized. And actually, there's an aspect of the market that was highly fragmented, and a lot of trends, especially with the streaming trends that we're well aware of today, that were also driving the potential, increased return outcomes. And so that was a new opportunity where we built some concentration into at that point in time. That was an area that we felt was, again, appropriate for an institutional investor, but not necessarily institutional in itself. If you look at today, I don't know that there are anything from an investment standpoint that's completely obvious, but I do think that there are markets that lend themselves and some still longer term themes that are interesting. So, if you look at public equity markets, not every public equity market is necessarily, the most favorable market. Some markets capture better earnings and economic returns than other markets. So, we're invested in Europe, but we're not invested in Europe. We're invested in Northern Europe. We're invested in Japan, but we're invested more in small and mid-cap Japan through an activist-oriented strategy. We're invested in Southeast Asia, but at least our decisions thus far has been less to go towards the public markets in Southeast Asia, but we really like the private market opportunity in Southeast Asia. And so in certain markets, we've leaned to parts of those markets, whether that be more of a geography base such as Europe or more of a cat base such as Japan. In other markets like Southeast Asia, we've leaned to be more private versus public. And then some markets certainly have depth and maturity in both the public and the private side. And so we have exposure there, certainly the United States being the case there. But even within the US, we do believe there are certain sectors that have really supportive long-term trends, like biotech, and not because it's Mount Sinai and not because we're investing in biotech because we're in healthcare. It's really, I think, a team-owned long-term belief in where value can be created, the specialization that goes into understanding biotech, the areas of innovation and technology that also influence biotech. And then frankly, the valuations there are still very attractive today. And it's something where if you have a long-term horizon, a lot of the tourist capital that came in has really left. And so you have a core of very committed investors that are there in the biotech space with the capability of specialization. And yes, there's volatility there, but there's a lot of value add too. So those are some examples in terms of historical, kind of intermediate time periods, and then also more present how we're thinking about some things.
Yeah, and I like the way you look at markets in terms of, should you be in public versus private? Should you be in the large cap Japanese exporters or mid cap? And then should you be passive or active? And you've chosen constructivism. It sounds like I can probably guess, but one of the managers. But anyway, you touched upon technology and biotech, but moving away from biotech, any ways you're using technology to innovate and improve alpha from an investment management perspective?
Yeah, so when you ask that question, I think of two things. The first one, I would say, there's nothing too novel for what we're doing versus what I think other investors are already doing, and that's more, I think, the internal use of technology. And when we have risk management, exposure, database, CRM, like we have all this software and technology support internally there. We're not using some program that I think is providing kind of outsized benefits at this point in time relative to other investors. Outside of the internal use of technology, which is very important, not to make also light of it, because I think all those resources provide tremendous support and help us in what we're doing. But the investing opportunity set itself, has been something that we have pushed into and continue to find attractive. I read maybe about a year ago, I had read it a long time ago, and someone brought it up in a manager meeting. I was like, I'm going to go back and look at that, because, a lot of times books that were written, especially a book written about technology in the late 90s, not so relevant. But it was a book called Technological Revolutions in Financial Capital by Carlota Perez. And it's like, you read that book that was written in the late 90s, it sounds like you're reading a book that was written last year, and it still really holds up. And so I do believe, and the reason I bring that book up in the aspect of technological revolutions, I do believe that we've had this revolution which has already occurred, and now we have these cycles that build on that. And as you build cycle on cycle, you get to this term super cycle, and you have this larger trending opportunity set. Now, doesn't necessarily mean that you just invest and valuations matter, and certainly the hype of what can be versus what is today, all those things and lessons learned and issues you come across. But certainly the internet bubble of what was 20 plus years ago, I mean, we've seen the fruits of that. It just didn't happen then. But I do think that the duration and the time periods of where we see these waves and these cycles, I mean, that is being compressed. And so it's the hype of blockchain and digital assets, which maybe people are completely disregarding today, I don't think has gone away. Now, I think there's a core there that still is interesting, and I think we'll see some things that we'll look back and say that's quite innovative over time. The hype of AI, which is today, I think a lot of the incumbents are the early winners there, and that's not to say that new companies and kind of the froth of capital into new deals, some of that may not prove out, but the valuations are quite high. And it may be a little bit more before we see where some of the applications really have a valuation effect. So I think that just naturally we tend to extrapolate sometimes faster than we should, but we do have dedicated investments targeting technology opportunities, whether that be through biotech and healthcare, or whether that be more through the application of data and enterprise, and focused in on early stage and seed investing, and having some of that early stage and seed investing, not just U.S. but global. Because again, getting back to some of these markets like Latin America and Southeast Asia, if you look at internet penetration, smart device adoption, and you look at the technology-enabled businesses, you're not trying to necessarily just build some global powerhouse that's going to compete against a U.S. company. You have local businesses that can create new entrants and capture other customers that, those customers did not exist. You don't have to cannibalize. And so there's ways to create efficiency to capture new customers and grow earnings that are available in some of these markets where it is interesting. And so we are very much, I think, finding that this technological revolution that happened some time ago, that these compounding cycles are providing opportunity, while not trying to just necessarily, bet the farm on that, but being careful about vintage year diversification and the timing of how we do it and paying attention to valuations along the way.
Yeah. Look, I couldn't agree more with much of what you said in terms of technological adoption cycles increasing rapidly. Then in terms of the what maybe you weren't quite as blunt, but excessive or immense hype of AI now, right?
Excessive is a good word. I'll go with that too.
Yeah, exactly. I mean, AI has been around for 70 years. There have been what have been called, as you probably know, nuclear winters, where it's overhyped and then it disappoints. And but anyway, we could spend hours talking about AI and technology. But let's hit on the third pillar of this podcast, which is ESG. Why don't I'll leave it? I'll leave it an open-ended question for you. Thoughts?
Sure. And I'll try to make a few comments here. And if there's something I'm commenting on that you would like to, drill down on, let me know. I mean, the very first thing that I think our investment office is highly aware of is we are working with a highly motivated, mission-minded organization where ESG in its truest form is being carried out, and it's important from the senior ranks to the community. So we want to ensure that what we're doing within the investment office, from not just prudence and as a fiduciary of this capital, but also just an alignment of values and principles, is supporting this mission for Mount Sinai. We have over 40,000 employees. There's important critical research going on. Sinai is certainly a medical leader, and it's also a community hospital. And so, ensuring how the investments are supporting that and that alignment is very much ESG related. When it gets to then the investment office and our engagement with managers and that process, we have and continue to individually engage with all of our managers on this conversation. We've been involved in helping one manager in particular really develop and build out their practice and policies here. But our focus with our managers on ESG is really twofold, and not that all investors don't do this, but one, certainly how are they integrating or focusing on these measures within their investment process? And, if they aren't, why aren't they, and how are they thinking about these factors? If they are, sometimes it's one or two, maybe not all three, and, how is it that they've been successful, and how do they approach the factors in their filtering and in their engagement with companies? And then the other piece, which is the internal, because it's one thing, allocators are good at this too. Allocators are always good at kind of pointing a finger and asking a question at managers, but never ask the question and point back at them. So I think, the internal conversation around how the manager reflects culturally these values and how ESG is reflective within their own firm, those factors are quite important too. And in fact, I think, the biggest issues that we have when we go through diligence with managers is addressing what we may perceive as misalignment. And that misalignment may be misalignment between the GP/LP. It may be misalignment between partners and employees internally at the firm. And sometimes that misalignment, or maybe not sometimes, all the time, but that misalignment is very much directly tied to ESG related issues. So these things are very important in terms of the sustainability of the strategy, of the outcomes of that strategy, of the team and the culture and the ability to be able to continue to drive those outcomes. And then I'd say kind of that next layer, and then I'll pause on any follow-up comments. There are, I think, some interesting opportunities within just the realm of ESG. And certainly the term, energy transition is, all these terms and investments are loaded and have a lot of connotations. I think there's some interesting opportunities around energy transition. And so that is a research project of the investment team that we continue to spend time on to better understand the implications, the winners, areas that are influenced by the energy transition that may be beneficiaries as we continue to think about forward opportunities.
Yeah, well, I couldn't agree more. I think the energy transition will create immense alpha opportunities, frankly, on both the long and the short side. Any preliminary findings on that before we move to the next topic?
Nothing that I'll verbally comment on yet, just because I still feel like I'm in a learning process, and so don't feel like there's any definitive. While I do believe there are investments being made today and opportunities that we will likely make at some point in the future.
Got it. Okay, fair enough. And then what moving away from the three sort of pillars, investing, ESG, and technology, what's the biggest challenge you face in achieving the goals of the fund or the various entities?
Yeah, I mean, there's the general challenge of the multiple things in the air all at once sometimes, where you have market events that can drive a need to focus, but that focus is on many different pools of capital, whether we're directly managing or advising on them. And then also, healthcare systems are complex entities, so it doesn't have to be some macroeconomic event. There can be things across the system that's more specific to the community or New York, or things taking place from a competitive aspect that cause the need to be able to focus time and energy. So I think the efficiency and effectiveness of time, which everyone faces, but with a large integrated healthcare system, you have to do that and do it very well. And you have to be able to kind of switch hats, because not every pool has the same objective. And at the same time, maintain the focus on the primary pool, because everyone's very much understanding kind of what that pool is trying to achieve. So I think the toggling and the ability to kind of address different needs, and potentially not always at different times, but could be at the same time, that presents challenges. I think from a just general investment standpoint, I think we all know this, but you just can't force returns. And so, being aware of what is the institution's risk tolerance, and while being aware of that risk tolerance, certainly aware of market opportunities, and just being cognizant and careful to not force, whether it's, the comment and the credit of reaching for yield, but in general, just being careful not to force the returns. Even though longer term, we've been able to drive those returns at any point in time, have to be careful about how that looks within the risk environment. And then, the managing of expectations. I think we all feel that the current environment we're in is the hardest one. And looking back at 2008, it seems like it's easy. And back in 2008, it wasn't easy at all. But I do think we have to recognize that it's been rather historical, what has happened in a recent time period between the global pandemic and a very inflationary period within the U.S., a very rapid response by the Fed. And not many investors have invested in an inflationary time period. And just kind of a comment historically on that, if you look across developed markets over longer time periods, in the U.S. having multiple kind of examples within this, but other countries too, it is more uncommon for there to be a single wave of inflation and then it to be done. It is much more common, if you put a statistic to it, it's more like 85 to 90%, for there to be multiple waves of inflation. And so I do think we have to be aware of the fact that while the Fed is certainly paying attention to inflation, we may not have quite seen the end. There could be multiple ways. We could be in an environment where rates stay higher for longer. And then also there's structurally, I think, reasons why inflation may be higher. Going back to aspects of ESG and climate and the impact on agriculture and insurance industry and supply chains redundancy, just with other, disruptions, and then also with the onshoring or nearshoring, all those things I think create structurally higher inflation. And so a higher rate environment is one that investors are less comfortable, or at least have less experience within. And so I think just being humble about that opportunity set and careful not to move into reach into risk at the wrong times is important.
Yeah, fair enough. One question I have for you, you didn't allude to, but in my mind, there was sort of a corollary. You obviously, you have a board as many or most institutions do. And I've had the privilege to and be invested with some of them, and they're super interesting, smart, thoughtful, brilliant people. What's the dynamic like in terms of the investment office and the board? Just curious on a little bit of color on that.
Yeah, absolutely. One of the reasons I was attracted for the Mount Sinai opportunity was the committee and the board. I figured, worst case scenario, I might survive for a short period of time and hopefully become a smarter investor in the process, because they are a very wise group of individuals that provide a lot of perspective. And I think within that, there is some important takeaways. One, they're busy in their day jobs and they're not in the weeds and the details in the investment office, but they are a partner in this, and they are truly a fiduciary alongside us. And so for us to be able, I think, to be effective, we certainly have to, be engaging with them so they understand how we're thinking about the world, how we're thinking about the implementation of that, and they can provide thoughts and feedback. And so using them in a partnership approach, which is the right approach, in my mind, for any committee, but particularly with this committee, is quite important. And even the structure for how we have set up, everyone ultimately has to be evaluated on whether they've done a good job or not. And even that structure for how we have things set up with the investment committee from a governance perspective, I think is quite unique. And we take into consideration qualitative elements that deal with setting goals and priorities and meeting those or not meeting those, the quality of our research and the quality of our communication. So there's a framework built around the qualitative, and then the quantitative components as well, because returns matter. Returns matter also over multi-year periods. And so how do you think about, the qualitative aspects of the process, the communication, the risk taken, and the other aspects of the return outcomes, and in thinking about those in ways where you're not trying to be, too cute, but balance those outcomes in a good, healthy process and a governance process. And so we have a review process that incorporates these factors as a framework. And then we sit down with our committee for really a formal just walking through this at the end of the year. And we take their questions and we talk about the year. We address anything that's from a qualitative or quantitative component. And ultimately, they have discretionary determination around how they view these outcomes, which if you're in partnership with your committee, there's trust that's in place. And you have to have a committee that understands it is, what it is you've done, but it's also on us to make sure that we've communicated what it is we're doing. And so I think the governance process between the investment office, Mount Sinai, and the board is well constructed, so there's balance. And then the team itself too fits within this kind of balanced structure where we've tried to, and I kind of alluded to earlier, and a little bit of the kind of improving alpha and more of the process component, we've tried to gain a bit of the benefit of both the specialist model and the generalist model, because there's pros and cons with both. Now, the outcome of that could be you end up in no man's land where you don't get any benefit, but we've tried to take the best parts of that. And so we get the best benefits of the specialization and the best benefits of the generalist model. And so to provide a very quick summary there, individuals on the team have dedicated coverage. There are areas where they have specialization. Every year, there's some aspect that's being rotated across the team, so there's fresh perspective. And every individual has an opportunity cost mindset where they're looking at across a layer of the portfolio instead of a vertical. And so they have benefits of specialization alongside the benefits of the generalist of the opportunity costs and trade-offs within this fresh rotation that keeps, I think, a new perspective put to the portfolio. And then added to that is just then the culture, which provides a lot of runway, a lot of responsibility, so that team members can, really take on as much as they'd like within the portfolio.
What advice do you have for other allocators and investors?
Yeah, I think I'm always looking for advice. I hesitate to give advice because I think more the listening and hearing advice is better. But I think the advice, if you're forced to say what advice you give, I think it's just allocators. It's easy for the fiduciary to force allocators to be focused on things that aren't necessarily the right fit for their institution. and how you just continue to create alignment with your investment committee, how you continue to ensure that it's your institutional needs that are being met, how you figure out how there might be skill sets or advantages for your organization or your committee members or your own experiences, and how you can use those effectively, because it can get dangerous and I think ineffective when we fall into the trying to copy or mimic, or fiduciaries are essentially just saying only invest in this, or why didn't you beat them? Those things, there's echoes of those things that are important, not to disregard those. But the need to ensure that the fiduciary, the institution, is being matched, and that's ultimately, we all know that as allocators, but it's just kind of how what are you doing actively to ensure that? Because there's passive, about it, and you may not be doing anything to actively, move that forward, and then other ways that I think can be, important and steps that can be taken.
Our discussion has been pretty comprehensive, but that said, anything we didn't discuss that I should have asked you, or you're discussing with other investors that's sort of highly topical or interesting to investors or allocators from could be from an innovation, investment, ESG, technology, or even more broader in other investment perspective?
No, it's nothing we touched on a lot, covered a lot of ground. I think we all enjoy this space just because we get to have the engagement with other smart individuals. We get to learn, we get to teach, we get to challenge our biases.
Scott, we would like to thank you for that interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for what one of our more thoughtful endowment leaders is thinking about and how they may benefit from this. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you for listening to Improving Alpha Innovation in Investing, ESG, and Technology, sponsored by Alternatives Watch and powered by Vidrio Financial. With Vidrio Financial Asset Managers, endowments and foundations, pensions, family offices, insurance plans, OCIOs, and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's VIDRIO.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.